This is Kurt Heisinger, accounting professor at Sierra College and author of Managerial Accounting. This video describes how to use the Scattergraph method with historical production cost information to estimate fixed and variable costs. I want to start by showing some characteristics of the Scattergraph method. First of all, the Scattergraph method considers all the data points. Again, we're using historical information to try to predict costs in the future. So the Scattergraph approach considers all the data points in that collection of historical information. It requires plotting all those points on a graph and then fitting a line through those points, and we'll go through an example in just a minute. It's a visual method that allows accountants to identify any unusual data points, which we typically call outliers. So when we actually graph those points, we can look at those points to see, are there any outliers out there and should we adjust for that? Also, the Scattergraph method tends to yield a more accurate result than if we were to use the high-low method. And there's a separate video that I put out there that discusses the high-low method. There are 5 steps that are associated with the Scattergraph method, and I'm just going to go through those steps quickly here, and then we'll get into it in more detail in future slides. So step 1 is to first of all plot the data points for each period on a graph. Then step 2, we're going to visually fit a line to those data points. Make sure though that as we do that, the line touches one data point, and that'll make sense as we get into the detailed example. Step 3 is to estimate the total fixed costs that we call that F, and then step 4 is to calculate the variable cost per unit, and we call that V. Step 5 then is to take all of that information and state it in the equation form of y equals F plus Vx, where y is our total cost, F is the total fixed cost, V is the variable cost per unit, and X is the number of units that we expect to produce. This slide shows us the historical monthly production costs for a company that I call Bikes Unlimited. I've been using this example in the other videos that relate to cost behavior and using the high-low method and account analysis approach, along with regression analysis, to estimate our costs. Let's assume that our company is called Bikes Unlimited and that we produce mountain bikes that are sold to retail companies. The information you see here relates to our monthly production costs. So the first column relates to the reporting period, the month that is, that we're looking at. The second column shows us the total production costs for each month, and the third column shows us the number of units that we produced for each month. The first step of the Scattergraph approach is to plot these points on a graph, which we're going to see on the next slide. Here's a plot of the data points that you saw on the previous slide. I used Excel to plot these points. You could actually do this by hand if you want to, but I did plug the points into Excel and have it print out this graph for me. But this is a plot, step 1, of the data points for each of those monthly periods that you saw on the previous slide. Step 2 then is to visually fit a line to those data points that we plotted in the previous step. So you'll see here that this green line represents the best fitting line that we could come up with those data points. And best fitting meaning that we want to get the line as close to each point and collectively to the points as possible. And remember, we need to make sure that the line touches at least one data point. It's fine if it goes through several data points, but we have to touch at least one data point because we're going to need that later on in a future step. So now, step 3, I'm going to talk about it while I'm on this slide because it's easiest to do that with the graph in front of us. But step 3 is then to figure out the total fixed cost. And the total fixed cost is where this green line, this line here, actually hits the y-axis. And the y-axis is just simply this right here. So wherever that line hits the y-axis, that becomes our estimate of total fixed costs. So looking at where the line hits the y-axis here, it looks like our total fixed costs are right around $45,000, which I'll talk further about on the next slide. As I talked about on the previous slide, we, in step 3, want to estimate our total fixed costs, and that estimate comes from where the line hits the y-axis. And in the previous slide, we noted that the line hits the y-axis at right about $45,000. It's a rough estimate, but it works for what we're doing here. And that means that we estimate our total fixed costs, total monthly fixed costs, to be about $45,000. It's monthly because the data set that we looked at a few slides back was monthly data. Again, this step will always be an approximation, but as I said, the $45,000 will work for us as we move ahead to step 4. Step 4 requires us to calculate the variable cost per unit, given the information that we have at this point, which is, we know our total fixed cost. So given that information, now we're going to go ahead and calculate the variable cost per unit. Remember, a few slides back I mentioned that we needed to make sure that that line that we drew hit at least one data point. And my line, the one that I drew, hit a data point which was $230,000 in monthly cost at a level of 3,500 units. So I'm taking the information from that data point and plugging it into the equation, this equation right here, so that I can solve for the variable cost per unit, for V. I should note that the data point that I used was for July. And it varies. If you did this on your own and drew a line, you'd probably come up with a different data point that the line went through, but that's fine. Just use the data point that the line hits, and in my case, it was the data point for July. The result then was to calculate the variable cost per unit, and the variable cost per unit in this example is $52.86. Now that we have our estimate for total fixed costs from the previous slides of $45,000, and we have our estimate of the variable cost per unit of $52.86, we can put that together in an equation. And here it is. Y equals, that is our total cost, equals total fixed costs of $45,000 plus the variable cost per unit of $52.86 times whatever the number of units is that we want to plug in to estimate Y, our total cost. So how would we use this? We would take what we expect to produce in the future for a particular month and plug that into X and solve for what our expected production cost would be given that level of production. So let's just take an example. Let's plug in 4,000. Let's assume that we're going to, or we expect to produce 4,000 units in the future, in a future month. Let's plug that in to estimate our total production costs. We would figure out our total production costs by taking $45,000 in total fixed costs and adding to that the total variable cost. And total variable cost is calculated by taking the $52.86 per unit times 4,000 units. We put this together. The $52.86 times 4,000 is $211,440, and we're going to add $45,000 to that to get the final number. And this results then in expected production costs at a level of 4,000 units of production of $256,440. So this enables us, by breaking out our cost into fixed and variable components, this enables us to estimate more accurately our production costs in the future.